Good day, fellow investors. Last month we discussed Starbucks and the risk and reward of investing, and I discussed how margin of safety would be maybe at a P ratio of 15 on equal growth. Back then the P ratio was 24, and after this happened yesterday, many of you asked for an update and to see whether it is something structural or just a temporary headwind. Well, Starbucks now is close to the lows of 2 years ago approximately. The P ratio is closer to 20 than to 25. The dividend yield is there, and let's immediately dig into the earnings to see what's going on. We have comparative sales 4% down globally, 3% down in the US, and 6% down international, or 11% down in China. When you see such numbers, so global weakness, you know that something is wrong, and the question is now, what and can that be mended? Globally, growth was 1%, ticket price increase 1-2%, plus the standard new store growth. They managed to mitigate these comparative sales. Comparative sales are like-for-like sales, so comparing the stores that were open at the same time last year with the current stores. So this is without the new stores, this is with the new openings that are aggressive across the board. But if you look at the numbers, something again very important is that the margin, the global operating margin, is down hugely because you have 140 basis points, that's 1.4%, which means that margins previously were 14.2%, and now those are down to 12.8%, which is again a big impact on productivity, a big impact on profitability. And you can see here the counter growth action, which is global store count 6% up, but with lower margins and lower sales, earnings per share 7% down. And if you look at the guidance, they are now guiding for still 12% growth stores in China, globally 6%, still growing in the US, but comparative growth decline, single-digit decline guided, which then raises the question, are we talking about a growth stock, or it will be only from new stores and trying to keep their position in a very, very competitive environment? And of course, also this year, flat to low single digits EPS, far from the 10-15% that was usually guided. Now, to see what's going on, best go to the conference call. This is the transcript, and I've just highlighted a few things out there, what's going on, and they say it is slower than expected recovery in China, but most importantly, they say it here, fierce competition among value players in the market. So China, if you open something, they can repeat it, open it again next to you, which creates a very, very difficult position for Starbucks because the brand might not be that strong, and I'll share something later with you too. Anyway, so what's going on? Consumer cautious, and they are continuing with their free execution opportunities, meet demand for future growth, launch even more exciting and relevant new products, we can discuss that also, and reach and demonstrate more value for occasional and non-Starbucks rewards customers. So they are going to discounts. Discounts means lower margins, lower profitability, lower growth, and they say they understand how to do this and what they have to do to deliver against their plans. For now, they don't, but okay. Then just listening to what they are doing, their lavender platform, extremely successful, lavender matcha, and then I'm thinking, yes, but imagine the competition with all of these strange products. Starbucks was this: cappuccino, caffè, latte e espresso, con un po' di pane. And that was the original one when some things like that were not easily achievable across the globe. Now you have that many same offerings, and going into Clover Vertica, coming in hot, red hot spices, be whatever things, I think really is maybe even cannibalizing the brand that Starbucks is. I'm looking for a coffee. I'm not looking for toilet cleaning lavender products. So that's something that is affecting Starbucks. And I went to tank at my local tank station, and I got a coffee for free. Okay, I said, okay, I'm driving, so I'll take one. And I drank it, and it was not different than a Starbucks quality. So the competition is certainly there, but let's now go deeper into the Q&A, discussing consumer caution, occasional consumers, but this was then the right question. From Jeffrey from Barclays: just wondering how you can be confident that the current challenges you're facing aren't in part due to maybe saturation of the market or cannibalization, as we discussed on the products. And I guess that does end up pointing to China, and for China specifically, I think you mentioned healthy unit economics and double-digit margins. Thus, the market is healthy, but Starbucks isn't reaching what they are saying. And then on the answer there, how they're going to grow in China, they want to enter more cities. They have still 2,200 cities to enter, so that's where the growth will come from. And there's also a discussion at China is at 13 cups per capita, Japan 280, and the US at 380. So there is still room to grow over time in China. But maybe they will not drink as many lavender matchas, cappuccinos, or whatever. And there is fierce competition. So the question is also about the margins there. Another good question about the long-term earnings with 5% same-store growth and consequently 15% growth in EPS that I conservatively discussed at 5% to 7% growth ahead in my absolute buy. I still think they could reach that, but not 15%. But that was a good question here, and they just keep talking how they will grow, how will they be inventive, new pipeline, and all the same blah blah that they usually discuss. So that is something to be watched over time, but my conclusion is that the company will likely grow. That's a given the new stores. Those stores are still profitable, thus it pays to grow like that, but it will take time. There will be ups and downs depending on how the lavender frappuccinos work, etc. But maybe the growth will not be as fast as expected, and as we always discuss, we want to be conservative. So yes, if we look at things from this stock price perspective now, it can still go both ways. I told you 15 would be a better margin of safety, closer to 10, and then people said it will not go from 90 or something to, let's say, 50 for a P ratio of 15 or lower, but it's already at 75. There is plenty of room to go lower, especially if they miss on the next quarters. Even if I think the management now will do whatever it can to push this next quarter on a better note so that they can show some growth to cater to Wall Street and to push the stock price higher. Because if we go back into our stock to buy categorization, yes, the market valuation is now even lower than the S&P 500. Thus, it is we could say a relative buy. An absolute buy, I was already conservative at 5 to 7% growth plus the dividend, which gives me a 7-8% return. Still, I would long term, given the stores and everything, if they can keep their position in the market, not even grow, just keep their position, I think this is achievable. So 8% return for me is not enough. You have to see whether it is enough for you. And for a margin of safety buy, it should be close to the 50s when you have the global, the position, the market, the dividend is already something close to the 50, close to 4%. So you are paid to wait till they figure those things out. I think they are going to do whatever they can to push the next quarter on a better note, but if they don't, then we could see it closer to 70, 65. If the market for some reason tanks another 10%, there you are at 50, very, very possibly. So I'm not going to include this into any of my portfolios, not even a covered stock. When it comes to 50, value investing, then we can take another look. For those that invest in these regions, there should be a good return, nothing stellar, nothing. Berkshire is still around there. So that line, you have to see how it fits you, or you have to have in mind the strategy that if it goes to 50, you can add more, reinvest, and build your position. There is a dividend, so that's something. And that's about it. I think that next quarter may be opportunity, but there are also risks. I'm not completely convinced, but it is something to follow. I know a lot of you like the brand, but the China competition is something very, very interesting because for them, Starbucks is as new as any other lucky coffee or something like that. So very, very interesting development. We'll see and we'll follow how the management tackles this. It will be a very few interesting quarters going ahead. Unfortunately, the situation is uncertain but also risky for Starbucks. So we need more information to see how it goes. If there is someone from China, if they can comment how does that new store look like compared to others, that would be great. Thanks for watching, we'll keep following, and I'll see you tomorrow in the next video about Intel.